David Bacher, good to have you in studio this month to talk about the Corion report.
Thank you, Alec. Always nice being here.
So, do you come up to Johannesburg often?
Probably pre-COVID every second week, so it's been a bit different over these strange times, but I'm back in full swing, so expect to see more of me.
It feels like that, doesn't it? That the COVID is now behind us. But what about the markets? I mean, the Corion report is great because you go through everything that could open and shut on the investment markets, give us performance reports going back over periods. Are you seeing that the COVID effect perhaps is now out of the system?
Certainly. I think touching on the Corion report, I mean, thank you for that compliment. What we try and do there is try and take what's quite a complex investment world and make it concise and to the point, and linking that to COVID. I think that's what people want. People want, highlights, information quickly. We're in a new era, and I think that's what speaks of the Corion report and why it's been received so positively.
So what's the big highlight of the past month, the month of March? We saw January, February horrible for investment markets in the US in particular. March, a lot of an improvement there. But how about here in South Africa?
I think for South African investors, it's been another very good month. What stood out for us at Corion was certainly how well South African asset classes have done. If you look at the first 3 months of this year, South African equities have outperformed global equities by about 25% or just short of that number. That's significant, it's material, and obviously it benefits investors. So, and bonds aren't too dissimilar, significant outperformance of South African bonds relative to global bonds. So, South Africa, you could say, has been in the sweet spot of the world, which is nice to say for a change.
David, I know you've been to the BizNews conference, but the last conference, BNC 3, because we're coming in 5 months' time, we'll be at number 4. There was a guy there, JP, who actually ended up playing golf with through our random draw. And he gave R1 million to find out who is going to be, or invested R1 million, who's better, Magnus Haystack with his offshore fixation or Piet Viljoen who focuses internally. They've each got R500,000. I think we're gonna give them another 3 months before we see how they're doing. But from what you've just said now, Piet must be way ahead.
I would presume so. I think, it also always depends on your starting point. But when that competition came out at Corion, we took a little bit of an internal vote, and we were all in Piet's camp, to be frank. We thought valuations of offshore markets were very, very high. South Africa was a swear word, but that was reflected in the prices. We were at what our view was a trough, and a lot of green shoots were starting to emerge. So at Corion, we've actually been positively positioned for South African rebound. A lot of the rhetoric at that point in time, get your money offshore, but the rand was at 16-17%, and our all-share index was at a lot lower levels. So in the context of what you're paying for future earnings, we thought that South Africa was a very compelling investment proposition. So
you make that point. I mean, the rand about 16 to the US dollar. Now we're in the 14s. So it's been quite an appreciation. We've also seen last week that SARS's collections are just way higher than was anticipated, almost 400 billion rands better. So I guess South Africa is well positioned for the craziness that's happening in the world right now.
It's unbelievable. We didn't predict the war, but if you think about the benefits of the war relative to other geographical regions, obviously war's never a benefit, but we are actually in quite a sweet spot. If you think of all the exports of South Africa, those are the exports of Ukraine and Russia, and the commodity prices have gone up, bigger tax collections. So relative to the rest of the world, I would say South Africa and probably Brazil are best positioned to actually, as an investment destination, given what's going on around the world.
David, just explain that. If the rand appreciates, South African fixed interest instruments, in other words, bonds, as you mentioned earlier, they would also get, or their pricing, as long as the interest rates don't go out of kilter, their pricing in global terms would also appreciate. Is that the way it works?
Correct. Our analysis shows there's quite a strong correlation between rand strength and bond appreciation. When investors are thinking that the currency, which is a big component of their returns, going to appreciate, then they're not only going to get the benefit of the coupon or the interest, but they're also going to get the currency appreciation. So, that's the reason why strong rand, strong bonds, strong financial equity shares, stronger SA incorporated equities.
So what funds are excelling? Piet Villion's funds, I'm sure, have done very well, but what others?
So, it was almost probably a year and a half ago when I looked at a financial article, and it wasn't just in this journal, it was in many journals, and the title was more or less, "Is Value Investing Dead?" And, at Corion, we don't believe investing is a fast fashion. It's not a theme. You don't go on what was winning or outperforming over the last 5 to 10 years. You take a long-term view, and investments, a long-term means 20, 30, 50 years, and see what investment strategies work over time. So although value underperformed significantly for a decade, if you look at the Corion report and see which funds are outperforming, it's pretty much all the value funds that are at the top of the chart. So those investment managers, and hopefully, which are unfortunately doubt, those clients who stick to the investment strategy and took a longer term view, have benefited significantly over the last 2 years.
That's an interesting point. I keep writing in the BizNews Premium newsletter to people to say, look, investing is a long-term game. Don't get panicked by these short-term bumps. In fact, we look at a minimum of 5 years, a 5-year project, but you're saying it should actually be even longer than that.
If you look at a person's investment horizon, the majority of people are saving for retirement. That's a 20, 30, and when you start 45-year period. So, it's very hard to time the markets. I do think, at times our industry sells what is easier to sell. They sell into fear, they sell into panic. And the man on the street, looks at the last 3 years, last year, what his friends' investment returns have done, and think that's going to play out in the future. And, I think that's very often to the detriment of the end consumer.
The bigger houses seem to be struggling a little bit. Why is that?
So let me first answer that question by saying South Africa is blessed with some very gifted, skilled asset managers. At Corion, we used to call them the CIA, Coronation, Investec, Allan Gray. We have to change that because Investec changed their name. But, very smart teams, great businesses. But I think in the South African context, our market is a lot smaller than it used to be. There's less shares. It's less illiquid. And you have big houses chasing the same top 40 shares. It's very hard for them to go outside the top 40 shares. Liquidity is a major constraint. Now, what's driving the markets over the last 2 years, has predominantly been small caps, mid caps, and they can't really go and hunt in that area of the market, or they can, but it's a lot more difficult. And I think you're starting to see that in terms of their returns, where the asset management firms, the smaller firms, are really outperforming them over the last year to 2 years.
I was surprised when we did the numbers on the individual stocks and saw that the worst performing share on the JSE in the first 3 months was Prosus, 38% loss. Now, if you're a big asset management firm, because Prosus is such a big part of the index, I guess you got to have a chunk of those. Did the big guys, were they unable to lighten it? Whereas I suppose if you're more nimble, you might have been able to do so.
I think, I can't speak for the whole industry, but, you have a share that is Naspers plus Prosus, let's say 8 to 10% of the all-share index. For a big house not to have any of that share is a major call and major relative bet for their performance. So no doubt the overwhelming majority of big houses would have it, because it's a big bet and because it covers a large part of the market. And if they don't have it, where do they invest the remaining 8%? So yes, certainly I think there's probably some managers, and I do know of a few large asset managers who still believe in the Prosus Naspers valuation. So they're probably there for their own investment merits. But there are also some who I don't think can have an alternative because it's just such a big share in the market.
And that would obviously have affected them as well. So I suppose more of an anchor. We talk about, Warren Buffett talks about size being an anchor to growth. In a South African context, because of the big weighting of Prosus and Naspers, it's a significant anchor if it underperforms like it did.
Correct. I think if you had to make 2 calls, if you were going to outperform your peers, what did you need to do? You needed to avoid Naspers and Prosus, and you probably need to be overweight small and mid caps in the South African market. I'm summarizing it a lot, but I think those are the 2 big calls because of the influence of the asset managers to Prosus and to large caps. I think I looked at a research report last month, and I would say 75% of the industry had 4% or greater exposure to Naspers and Prosus.
Yeah, so that does impact your performance a lot, particularly in this quarter. What about the change in the offshore limits for pension funds, this Regulation 28, which now seems to be a little bit, not a little bit, significantly more freedom for funds to invest offshore?
Correct. Significant, I think, is the word. If prior to a month ago, you were only allowed to invest 30% of a retirement fund offshore. That increase has gone to 45%, so a 15% increase is significant. What it means for investors is greater diversification. You're not exposed to the South African risk as much as you were. You have access to shares, industries, geographical regions that you wouldn't have over the last 20 years, which we think over the long term will result in better risk-adjusted returns for clients.
Well, we know that offshore markets have done a heck of a lot better than South African markets, but I suppose overlay the fact that many stocks are delisting on the JSE, and you really do, if you're in equities, you really do need that greater selection. Have they moved already? Have the funds taken full advantage of the additional allowance?
I think a lot of quantitative analysts are doing a lot of numbers, trying to see what's the right strategic asset allocation, and to move, let's say, a retirement fund from an asset allocation of 30% offshore to 45% takes time. So I expect it will increase. I am aware of some houses that have pushed the button already, but the majority of investment houses are taking a staged approach. And I would believe, over the next year, they will build from what we see in the average in the industry, about 28% to about 36, 37%.
And it's a good time to do it with the rand so strong, relatively speaking.
Correct. Well, rand is notoriously difficult to predict, but that's our view. Certainly, rand strength, we're pretty much at levels that we think is appropriate to take your money offshore.
And how has the strengthening of the rand affected performances, particularly when you look at March?
So, if you look at March, rand was up just short of 4%. Which shares outperformed? Financial index was up about 12%. Bonds were relatively strong, and the laggards were resources. So if you got your rand call over the last month, you pretty much knew what was going to outperform. So strong rand, strong financials, interest rate sensitive shares, and those managers that were exposed did really well.
How, when we look ahead now to the second quarter of the year, because we've now had our first 3 months. It's incredible how quickly it's gone. Okay. Look at ahead to the second 3 months of the year, assuming that commodity prices stay strong, assuming that Putin doesn't pull out of Ukraine in a hurry. How would you position a portfolio if you were able to do it right now? Because then we can have a look back at the way institutions are actually positioning themselves.
I think we actually discussed this at our morning investment meeting at Corion. So we think emerging markets is a place to invest going forward. We still think the majority of developed markets are at high valuations. Emerging markets have come off a lot more. They've underperformed over the last 5 years. And generally speaking, if you invest in emerging markets, you expect a higher equity risk premium. You expect a higher return over the longer period. That hasn't happened recently. So, I think most of those emerging markets will benefit from stronger commodity prices, which we see, and also they've come a lot, so on depressed valuations. So if you're asking us where we're tilting our client assets, it's more from developed market equities into emerging market equities.
And the resources run, it's been so interesting to watch this because it's been going for a long time now, and every man and his dog who follows resources has been calling it lower and lower, and keep the prices keep going up. Thank goodness from a South African perspective. But how are you guys reading that?
We still think that, given where spot prices are of majority of resources, the valuations of the shares are still quite compelling. So we'll be overweight resources, not as much as we thought previously. We do expect a softening of a lot of commodity prices over time, but given the valuations, they can soften quite a lot more and still result in strong investment cases for many of the resource companies.
It's interesting also if the rand were to regress in any degree, that those resource share prices would actually have to do a lot better.
Correct. I mean, when you're buying resources, you probably you have to get 3 decisions. If you can get all 3 decisions right, you make a lot of money. The currency, the commodity price, and your starting valuation. And sometimes your starting valuation with resources is the least important because there's such a gearing in terms of the rand commodity price on the revenue line of resource companies.
If you take those 3, your starting valuation, as you're saying, it's certainly not overvalued.
Correct.
The rand is pretty strong by recent standards, so
Correct.
There's a likelihood of a weakening there. And the commodity prices look like they might be stronger for longer. So I can see the logic.
Yeah. So I would say even if they're not stronger where they are, if they just keep at the current value, current commodity prices, then I think you got enough of a wind behind you to outperform.